The ATM screen blinks, then goes dark. You try another, same thing. A line is already forming behind you, people checking their phones, refreshing banking apps that won't load. It's 9:47 a.m. on a Tuesday. 72 hours ago, the global settlement system stopped accepting dollars for oil transactions. You didn't notice. Most people didn't, but the markets did. Let's rewind. In this simulation, we're examining what happens when the mechanism that has underpinned global trade since 1944 suddenly fractures. Not through war, not through revolution, through something far more mundane, a coordinated shift in how the world's largest economies choose to settle energy transactions. It begins with a joint announcement from BRICS nations and 3 major Gulf states. They will accept yuan, euros, and a digital settlement token for crude oil. Dollars will still be accepted, but at a floating discount that adjusts hourly. The statement is released at 11 p.m. Eastern Time on a Sunday. Markets are closed. By Monday morning, every major financial institution in the Western world is in crisis meetings, because what most people do not understand is this. The dollar's value isn't backed by gold, or GDP, or military strength. It's backed by necessity. Every country needs dollars because every country needs energy, and energy has been priced in dollars. Remove that necessity and you remove the floor. Hour 1, forex markets open in Sydney. The dollar drops 4% against a basket of currencies in 18 minutes. Circuit breakers trigger, trading halts, resumes, drops another 3%. By the time London opens, the move is being called the largest single-session currency event in modern history. But it's not the speed that terrifies the professionals watching. It's the liquidity. Normally, currency markets are the deepest, most liquid markets on Earth. Trillions in daily volume. But now, there are no bids. Everyone is trying to sell dollars. No one wants to catch the knife. The Federal Reserve issues a statement before U.S. markets open. Calm, measured. They have tools. They're monitoring the situation. It's carefully written to avoid the word crisis. The Dow opens down 2,000 points in the first 90 seconds. The Nasdaq is worse, but it's the bond market that reveals the real damage. 10-year Treasury yields spike from 4% to 7% in a single morning session. That's not volatility. That's a repricing of American sovereign risk in real time. Here's what that means. Every pension fund, every insurance company, every foreign central bank that holds U.S. debt just watched their portfolios lose 15 to 20% of their value in hours. And many of them are leveraged. They borrowed to buy those bonds, assuming stability. Now they're getting margin calls. Forced selling begins. A feedback loop is forming. By Monday afternoon, the term reserve currency is trending globally. Financial news networks are running explainers. But the real pressure is happening where cameras don't go, inside the plumbing of the financial system. We assume, for this simulation, that you understand how dollar dominance works in practice. It's not just that oil is priced in dollars. It's that correspondent banking, trade finance, derivatives clearing, euro-dollar deposits, all of it runs through a system designed when American economic supremacy was unquestioned. That system has a single point of failure: confidence. Monday night. The president addresses the nation. The speech is optimistic. America's economy is strong. The dollar is resilient. We've faced challenges before, but there's a section near the end about potential emergency measures, temporary capital controls, coordinated action with allies. The phrasing is vague. It has to be, because anything specific would trigger the very panic they're trying to avoid. The speech ends. Asian markets open. The dollar falls another 6%. Tuesday morning. You're starting to see it in the real world now. Gas stations in 3 states have raised prices overnight. Not gouging, repricing. Fuel is imported, paid for in dollars that are worth less every hour. Some stations are limiting purchases, 20 gallons maximum. Others are cash only, because credit card processors are setting new exchange rate holds that make transactions unpredictable. This is the second order effect. The currency crisis is becoming a supply crisis. The grocery store still looks normal, shelves are full, but the manager knows what you don't. The warehouse shipment scheduled for Wednesday has been delayed. Their distributor is renegotiating contracts because their costs are spiking. 70% of goods in an American supermarket have touched international supply chains. Those chains run on credit, trade credit, letters of credit, all denominated in dollars, all now suspect. By Tuesday afternoon, 3 regional banks have quietly been placed into FDIC receivership. You won't hear about it until Friday. These aren't crypto startups or bad actors. They're institutions that made the same bet everyone made, that Treasury bonds were risk-free. They held long-duration bonds. When rates spiked, the value of those bonds collapsed. When depositors started pulling cash, the banks couldn't sell the bonds without realizing catastrophic losses. They became insolvent not through recklessness, but through the failure of the single safest assumption in modern finance. Larger banks are holding, barely. They have liquidity lines with the Fed, they have diversified books, but they're also hemorrhaging deposits. High net worth individuals are moving money to Swiss francs, to gold, to offshore accounts. Retail depositors are hearing rumors and withdrawing cash. Not everyone, but enough. A bank run doesn't require panic. It just requires 5% of depositors to pull out faster than the bank can liquidate assets. In a fractional reserve system, no bank holds enough cash to cover all deposits. They never have. Wednesday morning, you go to the ATM. Daily withdrawal limits have been cut in half. The screen says it's temporary for your security. But you can feel it, the tightening. Elsewhere in the city, payment systems are glitching. Venmo transfers are delayed. Zelle is capping transactions. It's not a technical failure. It's the system protecting itself, slowing the velocity of money moving out. Corporate America is in free fall. Any company with significant foreign revenue or debt is being destroyed. Their earnings are in weaker dollars. Their debts are in the dollars they borrowed when the currency was stronger. Airlines, manufacturers, tech firms with global operations, all seeing credit ratings downgraded in real time. Layoffs are announced, not next quarter, immediately, survival mode. But there's a strange divergence happening. Certain assets are surging. Gold hits $3,000 an ounce. Bitcoin, despite its volatility, is up 40% since Sunday. Not because people believe in it, because they don't believe in anything else. Commodities are spiking. Wheat, copper, lithium, anything with intrinsic value. The financial world is relearning a lesson it forgot. Paper is only worth what someone will give you for it. Wednesday afternoon, the Fed announces an emergency rate hike, 200 basis points. It's a desperate move. Raise rates, attract foreign capital back, stabilize the currency, but it's also a kill shot to the domestic economy. Mortgages, car loans, credit cards, all just became vastly more expensive. Housing markets freeze. No one's buying. Sellers can't find bids. The wealth effect, the feeling of prosperity tied to asset prices, is reversing violently. Globally, the response is fracturing. The European Union is in emergency sessions, trying to insulate the euro from contagion. They're partially succeeding. The euro is weakening, but not collapsing. China says nothing publicly, but UN swap lines with developing nations are being activated. Quietly, structurally, the architecture of a post-dollar system is being built in real time. Countries that have wanted an alternative for decades suddenly have permission to move. Wednesday night. The term bank holiday is floated on financial television, quickly retracted. But the idea is out there. Historically, when banking systems seize, governments freeze them, give the system time to stabilize. It happened in 1933, in Cyprus in 2013. In this simulation, we assume it's being discussed at the highest levels. The problem is, in a globalized, digitized economy, a bank holiday doesn't pause the crisis. It confirms it. Thursday, 48 hours in, cracks in civil order are appearing. Not riots, not yet. But tension. Gas stations in suburban areas are running dry. Trucks are still moving, but drivers are demanding payment in cash up front. Some are refusing long routes. Too much uncertainty. Grocery stores are rationing staples, eggs, bread, rice, not because there's no food. Because the logistics of getting it to shelves have been disrupted by the financial crisis bleeding into the physical world. Social media is a mix of confusion, anger, and conspiracy. Verified accounts are trying to explain fractional reserve banking in euro-dollar markets to audiences who just want to know if their savings are safe. Misinformation spreads faster than corrections. There are rumors of a Chinese cyber attack, of secret gold seizures, of martial law. Most are false, but fear doesn't require facts. Corporations are making decisions that will reshape the economy for years. Tech giants are laying off tens of thousands, not because revenue disappeared, because their stock-based compensation is now toxic, their access to cheap credit is gone, and their growth model assumed a stable currency. Pension funds are in quiet catastrophe. They promised returns based on bond yields that no longer exist. Retirees will feel this for decades. Some are benefiting. Hedge funds that shorted treasuries, commodity traders. Wealthy individuals who move to hard assets early. There's always a winning side in a collapse. It's just never the majority. Gold dealers are overwhelmed. Premiums on physical metal are 30% over spot price. You can see the price on a screen, but try to buy it. Wait times are weeks. Thursday night. The president invokes emergency powers. Temporary capital controls are imposed. You can't move more than $10,000 out of the country without approval. It's framed as protecting the economy. It's really protecting what's left of the currency. Markets react poorly. Asian exchanges open down another 8%. Friday morning, 72 hours. You're starting to see the third order effects. The ones that don't make headlines because they're too diffuse. Small businesses closing, not filing for bankruptcy, just locking the doors. Their credit lines are frozen. Their customers aren't spending. Construction sites going quiet. Projects half finished, abandoned when financing evaporated. Employment is collapsing faster than the statistics can measure. Internationally, the realignment is accelerating. India announces it will accept rupees for certain exports. Japan, long a U.S. ally, quietly begins discussing yuan reserves. The Middle East, flush with oil wealth, is negotiating new trade corridors that bypass Western financial systems entirely. The world isn't ending, it's reorganizing. And the United States is no longer the center. Some banks are surviving, the largest ones. Too big to fail is no longer a criticism. It's a literal survival trait. They're absorbing smaller institutions, growing even more systemically important. The consolidation will mean less competition, higher fees, more control in fewer hands. But in a crisis, size is safety. Friday afternoon. Markets close for the week. The Dow is down 31% from Sunday, the worst week in a century. But it's the velocity that haunts professionals. Crashes used to take months, this took days, because the infrastructure of modern finance, the speed of information, the leverage in the system, the interconnection, it all amplified the collapse. Over the weekend, you see the psychological shift. Lines at gun stores, runs on generators. People aren't preppers. They're accountants and teachers and engineers who suddenly don't trust the system to provide. Supermarkets have security guards, not because of looting, because of the tension in the aisles, the look in people's eyes when shelves are empty. The government is working on a plan, a new currency peg, a restructuring of sovereign debt, emergency stimulus. But all of it requires trust. And trust, once broken at this scale, doesn't return quickly. Some economists are using the word depression. Others push back. GDP hasn't collapsed. Unemployment isn't at 25%. Not yet. But the mechanisms that prevent that, credit, liquidity, confidence, are all damaged. Globally, we're watching the birth of a multipolar currency world. The dollar will still exist. It will still be used. But it will be one option among many. And for Americans, that means something profound. The era of importing goods with printed money is over. The era of cheap credit backed by global demand for treasuries is over. Living standards, expectations, the baseline assumptions of American life, all are being repriced. In this simulation, we don't see revolution. We see adaptation. Painful, unequal, generationally damaging adaptation. Some will protect wealth, most won't. The distance between classes will widen. Not through policy, but through the simple reality that hard assets survive currency crises, and most people don't own hard assets. Monday morning, the markets reopen. Volatility is still extreme, but the free fall has paused, not because the problems are solved, because the initial shock has been absorbed. The new normal is being established. It's worse than the old normal, but it's stable enough to function. You check your bank account, the number is the same. But you understand now what you didn't before. That number is a promise. And promises are only as good as the system that makes them. The system just showed you it can break, quickly, completely, without warning. History will record this as the week the post-war economic order ended. But you'll remember it as the week you couldn't get cash from an ATM. The week gas hit $9. The week you realized that the invisible systems you never thought about were the only things holding the world together. And once you see that, you can't unsee it. If you found yourself unable to look away, there's more to understand about the systems we trust without question. Stay curious, stay prepared, and maybe hit subscribe.